There is one investing mistake that 80% of people make. It's not picking the wrong stock. It's not failing to diversify. It's not even paying too much in fees, although that's a close second. It's something most people don't even realize they're doing until they look at their portfolio 10 or 20 years later and wonder why the numbers are so much smaller than they should be. This mistake has quietly cost the average investor over $200,000 across their lifetime. And the worst part, it feels completely natural, it feels rational, it feels like you're being smart. By the end of this video, you'll know exactly what the mistake is, why your brain is wired to make it, and the simple system that protects you from ever falling into it again. Let's get into it. First, let me clear something up. When I say 80% of people make this mistake, I'm not exaggerating for views. Multiple studies from Dalbar, from Morningstar, from Vanguard have looked at how real investors actually behave over time. And they keep finding the same thing. The average investor earns dramatically less than the market itself. Think about that. The S&P 500 might return 10% in a given year, but the average person invested in S&P 500 funds earns somewhere between 3% and 6% in the same year. Same fund, same time period, massive gap. How is that possible? They're in the same investment. How are they getting different results? The answer is the mistake we're about to talk about. And once you see it, you can't unsee it. The mistake is this: emotional timing. People buy when they feel confident, which is usually after the market has already gone up a lot. And they sell when they feel scared, which is usually after the market has already gone down a lot. Buy high, sell low. The exact opposite of what works. Now you might be thinking, that's obvious. Nobody would actually do that on purpose. And you're right, they wouldn't. But that's not how it happens. It doesn't happen as one big decision. It happens slowly in small choices that feel completely reasonable at the time. Let me walk you through how it actually plays out in real life. It usually starts with you not being invested. You've been meaning to start, but you're waiting for the right time. Then the market has a great year. Everyone is talking about it. Your coworker mentions she made 15%. Your cousin is suddenly an expert. The news is covering record highs. You feel like you're missing out. So you finally put your money in. Then, a few months later, the market dips. 5%, 10%. Your portfolio is in the red. The same news that was covering record highs is now showing graphs pointing down and using words like correction and uncertainty. You start checking your account daily. The discomfort builds. After a few weeks of watching your money shrink, you can't take it anymore. You sell. You tell yourself you'll get back in when things stabilize. The market then recovers. You watch from the sidelines as your former portfolio would have grown back and then some. You wait for a pullback to get back in. The pullback doesn't come, or when it does, it's small, and you tell yourself it could go lower. So you wait. Eventually, the market is at new all-time highs, and you've been out for 2 years. You re-enter at the top, and the cycle starts over. This is the mistake. And the reason 80% of people fall into it is because every single step feels rational in the moment. This isn't a stupidity problem, it's a biology problem. Your brain is not built for investing, it's built for survival, and the same instincts that kept your ancestors alive on the savannah actively sabotage you in the stock market. Here's why. When you see something painful happening, like your portfolio dropping, your amygdala fires. That's the same part of your brain that would have fired if a lion appeared in your village. The signal it sends is clear. Get away from this. Run. Eliminate the threat. In the savannah, that response saved your life. In the market, it cost you your retirement. The technical term for this is loss aversion. Researchers have found that humans feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. A $1,000 loss hurts about twice as much as a $1,000 gain feels good. So when your portfolio drops, every cell in your body is screaming at you to do something, to act, to make the pain stop. Selling makes the pain stop. Right now, in this moment, it feels like relief. But every time you sell during a drop, you are listening to a brain that was designed to keep you alive, not to make you rich. There's a second psychological force at work too. It's called recency bias. Your brain weighs recent events much more heavily than older events. So when the market has been dropping for a few weeks, your brain extrapolates. It must keep dropping. When it's been rising for months, your brain extrapolates the opposite. It must keep rising. In reality, the market doesn't care what it did last month. It is responding to thousands of factors that have nothing to do with the recent trend. But your brain doesn't know that. Your brain just sees the pattern and assumes it continues. Put loss aversion and recency bias together, and you get the perfect recipe for buying high and selling low. Every single time. Let me show you what this actually costs in dollars, because the abstract version doesn't hit until you see the numbers. Imagine two investors. Both start at 25 with $10,000 invested. Both add $300 a month. Both invest in the same total market index fund. Both invest until age 65. 40 years of investing. The first investor, let's call him disciplined Dan, does nothing emotionally. He sets up his contributions on autopilot. When the market crashes, he keeps buying. When the market booms, he keeps buying. He doesn't check his portfolio more than once a quarter. He never makes a decision based on the news. At 65, Dan has roughly $1.4 million. The second investor, emotional Emma, does the same investments, but she behaves like a normal human. She panic sells about 30% of her portfolio during the major crashes, sits in cash for an average of 18 months each time, then buys back in once she feels safe. She also pulls back her contributions during scary periods. She does this maybe 3 or 4 times across her lifetime. At 65, Emma has roughly $780,000, same investments, same income, same length of time. The difference is over $600,000. That's what emotional timing costs. Not in theory, in real dollars, in a real retirement account. And the worst part is, Emma probably feels like she did a good job. She thinks she protected herself during the scary times. She doesn't know what she could have had, because she never sees the version of herself who stayed the course. Now, I want to point out that this mistake doesn't always look like full-blown panic selling. It often shows up in subtler ways that you might be doing right now without realizing it. Subtle version 1, pausing your contributions during a downturn. You're not selling, but you're also not buying. You're telling yourself you'll resume contributions when the market looks better. This is the same mistake in a quieter form. Every month you don't buy during a drop is a month you miss the discount. Subtle version 2, moving money to safer investments after a crash. You weren't comfortable in stocks during the volatility, so you shifted into bonds or cash. Now you feel calm, but you also locked in your stock losses and are sitting in low return assets while the market recovers. By the time you feel ready to move back, you've missed the rebound. Subtle version 3, waiting for more clarity before investing new money. Every time there's a big news event, an election, a Fed decision, a geopolitical crisis, you tell yourself you'll wait to see how it plays out before investing the money you have ready. So that money sits in a checking account, earning nothing, while the market does its thing. You never get the perfect moment of clarity, because clarity in markets is a fantasy. It only exists in hindsight. Subtle version 4, chasing what's hot. The market did well last year, so you increase your contributions. The market did poorly last year, so you decrease them. You feel like you're responding to information, but you're actually doing the opposite of what works. The best time to invest aggressively is exactly when it feels worst, and the time to be cautious is when everyone is most confident. If any of these sound familiar, you're not alone. You're in the 80%. And that's okay, because now you know. Here's the good news. You don't have to become an emotionless robot to beat this mistake. You just have to build a system that takes emotion out of the decision. There are 3 pieces. First, automate everything. Set up automatic contributions to your investment account on the same day every month, preferably right after you get paid. The money moves before you have a chance to think about it. You never decide to invest, because the decision was made once, in advance when you were calm. This is the single most powerful change you can make. The market is up, money still goes in. The market is down, money still goes in. You stop being a decision maker and start being a buyer, and buyers over time win. This is called dollar cost averaging. And it's not a clever strategy, it's an emotional defense system. When prices are high, your fixed dollar amount buys fewer shares. When prices are low, the same amount buys more shares. You automatically end up buying more when things are cheap and less when things are expensive, which is the opposite of what your emotions would have you do. Second, limit how often you look. The data on this is wild. Studies have shown that investors who check their portfolios daily underperform investors who check quarterly by a meaningful margin. The ones who check yearly do even better than the quarterly checkers. Every time you look at your portfolio, you give your emotions a chance to act. Every time you don't look, you take that chance away. Pick a check-in cadence once a month is plenty and stick to it. Delete the app from your phone if you have to. Your wealth will thank you. Third, write down your strategy when you're calm. This is the secret weapon. While you're not stressed, while the market is normal, sit down and write a 1-page document that says exactly what you're going to do in every scenario. What happens if the market drops 10%? You keep investing. What happens if it drops 30%? You keep investing. And if you have extra cash, you buy more. What happens if everyone is panicking on the news? You reread this document. The reason this works is that future you, in the middle of a market crash, will not be a rational thinker. Future you will be running on fight or flight. But past you, the version that wrote the document, was calm and clear-headed. Trust that version. Read what they wrote, do what they decided. Some of the best investors in the world do exactly this. They write down their rules in advance, then follow them no matter what their gut is telling them in the moment. Here's what I want you to take away from this video. The mistake isn't about being smart or dumb. The smartest investors in the world fall into it without systems in place. That's been proven over and over. Even Nobel Prize-winning economists have admitted to making emotional investing decisions during downturns. The mistake is about being human, and the fix isn't to stop being human. The fix is to build systems that protect you from the parts of being human that hurt you financially, automate your investments, limit how often you check, write down your rules in advance. That's the whole defense. Do those 3 things, and over a 30-year period, you will likely end up with twice as much money as someone with the exact same income who tries to make smart decisions in the moment. It's not about being clever, it's about being consistent. And the wild thing about consistency is that it doesn't require talent, it doesn't require a high IQ, it doesn't require access to inside information or a finance degree. It just requires that you commit once to a system and then get out of your own way for a few decades. That's it. That's the whole game. If this video changed how you think about investing, even a little, do me a favor and subscribe. Net Worth Nation is built for people who are done making the same money mistakes everyone else makes and ready to actually keep what they earn. Drop a comment below. Which of these subtle versions of the mistake hit closest to home for you? Have you paused contributions during a crash? Tried to time a re-entry? I want to know, and your honest answers help me make better videos for you. And if you know someone who's about to make this mistake, or who's already deep in it, share this video with them. You might save them 6 figures. I'll see you in the next one. Let's build